Welcome to Talk Tickers. Today, we're digging into LoveSac's Q2 earnings, and wow, what a disconnect. You've got the company telling one story, and the market? Well, the market heard something completely different. And the market's reaction? It was brutal. The stock dropped almost 15% in the pre-market. So what's going on here? Why the huge gap? Let's really get into it and figure out why management's long-term story just didn't land with investors who are, let's be honest, focused on right now.
Okay, here's how we're going to break it down. We'll start with the headline numbers, the good, the bad, and the ugly. Then we'll get into what management's trying to do with this big brand pivot. After that, we'll tackle the big one, the margin fears that really sent investors running. And finally, we'll give you our take, our rating, and what we're watching next.
All right, let's get right into those numbers. And honestly, it was a really mixed bag this quarter.
So take a look at this, because this is really where the story starts to split. On the one hand, you've got a solid earnings beat. They lost 45 cents a share, but Wall Street was expecting a 71-cent loss. So that's a win, right? And revenue, pretty much dead on the money. But, and this is the elephant in the room, that gross margin. It dropped 260 basis points from last year. That's a huge deal. And that one number pretty much erased all the goodwill from the earnings beat.
Okay, so with that ugly margin number out there, you can see management immediately trying to change the subject. They're basically saying, hey, don't worry about the short-term stuff. Look at the long game. We're gaining market share. We're building a brand for the future. And this is the slide they really want you to focus on. Look at this. LoveSac grew 2.5%. Meanwhile, the entire home furnishings category, it shrank by about 4%. That's the whole bull case in a nutshell. They are swimming upstream and actually making progress, stealing customers from their rivals in a really, really tough market. And the CEO, Sean Nelson, he's doubling down on this idea. He's saying, look, we're not just the Sactionals company anymore. The mission here is to become a true powerhouse home brand, one that can survive recessions and maybe even start selling totally new stuff down the line. It's a big, ambitious vision. And, they're not just talking a big game. They're actually doing stuff to back it up. They're controlling costs. SG&A is down. They're spending money on marketing for that new Snugg line. They're opening more showrooms. And maybe most impressively, even with all this chaos, they still squeaked out a small adjusted EBITDA profit. From their perspective, this is exactly what executing a long-term plan looks like. But the market just wasn't buying it. So now let's flip the coin and look at what investors were so scared of.
Yeah, so if everything's so great on the strategy side, why did the stock get absolutely hammered? What was the big red flag that had everyone rushing for the exits?
Well, it turns out the market basically ignored that whole market share story and zeroed in on four things. One, they slashed their profit guidance for the year. Two, that gross margin drop we just talked about. Three, management warned that the tariff situation is actually getting worse. And four, they had to take a nearly $2 million hit from ending their partnership with Best Buy. At the end of the day, it's all about profit, and every single one of these points screams less profit. And this table tells the whole story. Look at the guidance. They barely touched their sales forecast, but look at the GAAP EPS line. They took a hatchet to it. That's a massive red flag for Wall Street. It tells you they're going to make way less money on almost the same amount of sales. That is the definition of a margin crunch, and investors absolutely hate it. So where do we go from here? You've got management's sunny long-term view on one side and the market's storm clouds on the other. Let's try to balance them and figure out what's next. Now, to be fair, management didn't just ignore the problem. They laid out a 4-point plan to get those margins back on track. They're talking about fixing their shipping and logistics, moving more production out of China to avoid tariffs, being smarter about their sales and promotions, and then, just hoping the whole market gets better. It's a plan, but there are a lot of ifs. So, looking ahead, here's what you need to be watching. The big one is holiday sales. Do they hit their numbers? We need an update on those tariffs. Are they making any progress? Is this new Snugg product line a hit or a miss? And most importantly, can they stop the bleeding on gross margins in the next couple of quarters? That is the question. All right, so here's our call. We're rating LoveSac a market perform. Look, the story about taking market share is really compelling. It is. But right now, it's just completely overshadowed by all this uncertainty around their profits. The risk and the reward feel pretty evenly matched right now. We're going to stay on the sidelines until we see some actual proof that those margins are getting better.
And of course, just a reminder, this is not financial advice.